right, well, we're going to get started. And hold on for the audio issue real quick. Good morning, Graniterock people. Welcome to our financial town hall with certified financial planner, Jacob Young. We've all got a lot of money matters on our minds, whether it's trying to buy a house, saving for a kid's college, retirement planning, or knocking down debt. On top of all that, the economy seems to be all over the place with inflation and interest rates not in our favor. So Jacob is here with insights into the economy and strategies to secure our financial futures. And he will be taking questions, so please don't be shy. And with that, welcome, Jacob. Glad you're here.
Thank you, Shanna. It's great to be here again in front of all of you. And I want to make sure my screen is being shared. I think it says I'm presenting, so hopefully we're good with that. Okay, perfect. Well, welcome. It's been a while before we've done the last one, and I know what tends to come up after we've taken a little break is what's going on with the economy. Are we in good shape, bad shape? What should I be doing with my investments? What should I be doing with my savings? And so we're going to cover about specifically retirement planning, but this could also apply to if you're saving for something that's temporary, short-term, long-term. You can use the same information to apply to all of your investments across the board. The first thing before I get started on that is for those of you who've done our meeting reviews, we have moved just down the way from where we were, and we're still within a stone's throw of the Graniterock main office here. Across the street from California Grill, everyone seems to know that one, off of Penny Lane. So you're welcome, if you sign up for a meeting with us, this will be where we meet, and you're welcome to just stop by and introduce yourself and take a look around. We're eager to show it to everyone. Well, the stock market has been up and down. I don't know if anyone's noticed that. And there's a lot of things going on. We have persistent inflation. We have the Federal Reserve, and they're raising interest rates, and that slows growth down. We have geopolitical concerns, and that seems to be getting worse rather than better. And then just, are we in a recession? Is the United States going into a recession or not? So let's cover a lot of these things as we go through to help give you a little bit of ease about investing over time. Now, here's the thing that a lot of people don't realize. If you look at the graph here, you can see the S&P 500 in purple, the Dow Jones Industrial in orange, and the NASDAQ, which tends to include a lot of technology companies, in blue. They've all had very good returns over the last year or so. And if you look at if you try to just look at a couple months at a time or 1 month at a time, or even on a daily basis, if you really narrow in, you're going to go crazy. You can see there's lots of ups and lots of downs. But if you look at the long-term trend, it's all moving up. And so the general idea, if you took any idea home with you from this presentation, is we're going to see a lot of volatility with everything going on that I just mentioned in the previous slide, and it should be volatile to the upside given enough time. So don't look at your accounts on a daily basis. Don't look at it on a monthly basis. And even when you get your quarterly statement, if you still receive statements in the mail, don't even look at those unless you're going to retire in the next 3 months. Then we'll have a different conversation. We'll actually cover that in a little bit. But long term, if you have several years before retirement or many years before retirement, just think of the long term, not the short term. And this tells us as well that there's a lot of things that have gone on wrong throughout our history, well, both in the country, both in the world, yet the trend is up. The stock market continues to grow. And there's lots of bumps along the way, and depending on the day that you invest to the time that you look at. But if you can give it 5 years, and even the worst, the Great Depression, if you can give that 10 years to recover, you're going to be okay. So if you're 10 years out from retirement, or even 5 years, it's okay to own some stocks, own some aggressive accounts that will grow over time. And remember, don't watch it on a daily basis. Here's something else to just give you in perspective. It's very common to lose 20%. So 2022, the stock market was down about 20%. And that's common. That's happened before this chart came out. So we're at 7 times now. It takes about 2 years for that to recover. If you're looking at this bear chart here with the bigger bear. Now there's a very large bear. Those can be very times. Financial crisis, about once a year, there'll be a 5 to 10% drop, and that's just common. That's what the stock market does. And if you're in it for the long term, you don't have to worry about the day to day. It's the long term. Now, moving to the left over here, 90%, 74% of the time, the stock market has a positive return. You can't predict anything. So let's talk about some of the things that could drive it negative and whether or not we should worry about those. So one of the first ones on top of everyone's mind is inflation. Now, this is a chart. If you look at blue, that's inflation of things that are called persistent inflation, things that, think of like your doctor or a service, or maybe even Graniterock's bidding prices. Once those prices go up, they're usually not coming down. That's inflation that's persistent. Now, you may not raise those prices if inflation subsides, but you're not going to lower that price. Transitory inflation are things, that's the green line, and that's the things that prices tend to go up and down. Think of your food cost. Think of even something like a car. When the car companies produced a lot of cars and they need to get rid of them, yeah, there's the sticker price, and they don't negotiate as much as they used to, but they have sales, or they're willing to make a deal to get that particular car out the door. And sales will go on. Think of clothing stores. They're not lowering their prices, but they're having, these year-end sales once a month, one-time only sales more frequently. So if you look at the green, that hasn't gone up as much lately, and even the persistent inflation is going down. So overall, inflation tends to be going down, and the one that you watch the closest is the transitory. That tends to point to the direction that the rest of the inflation is going. So then the next question is interest rates. When the Federal Reserve raises interest rates, I don't want to get into too much, but I will make this point. The Federal Reserve does not control our interest rates. They control one of several different interest rates that are out there, but it makes a lot of news. And so if the Federal Reserve raises interest rates, other interest rates tend to follow. So this was the projected interest rate trend after about a year ago, and it was expected that by now we would see interest rates drop, and they haven't. However, they've remained steady. So that's put a little fear in the market that maybe the Federal Reserve raises rates. If I was a betting man and I was trying to give you my best guess, my guess is that the Federal Reserve won't touch interest rates until after the election. And by not touching interest rates, especially if inflation is still hanging around, and then after that, they might lower interest rates. Now, this is just a guess, and it all depends on a number of things, but the fact that interest rates haven't gone down as they were expected to, that's affecting the market. But then again, does what the Federal Reserve do to interest rates change if you're going to go buy that new iPhone? Does it change if you're going to go on that vacation? It might affect whether you're going to make that improvement on the house because borrowing's more expensive. But a lot of the things that you buy on a normal daily basis are not going to be affected by what the Federal Reserve does. So that shouldn't affect the economy in the long run. Now, here's the one I get a lot of questions about: geopolitical concerns. So if we look at the early 90s, after the dissolving of the Soviet Republic, it was pretty much the United States standing alone as the dominant power. And not to be offensive to anyone who's of any other nationality, but if you look at it on a global scale, it was the United States only. Before that, it was two major countries kind of playing tug of war. And now today it's a lot more unstable. China's a rising power. Russia has tried to come back. The European Union as a whole has a lot more control or power. And you could even argue other countries are moving up in the ranks. And now we have a lot more instability, especially in the Middle East and in the Eastern European region. If it was a big war, I always hate talking about this, but if you have a big war, that's actually good for the economy. These are smaller skirmishes as of today, and I don't want to make light of them, but they really don't affect what you do on a daily basis. And so I'm giving you advice, not on a humanitarian outlook on the world. There's some major concerns there, but on an economic outlook, the United States growth should continue. You most likely are going to continue to buy that iPhone, continue to go shopping, go out to restaurants. And that does make the United States grow, even with this political turmoil that we're going through. Now, something else, this is a blown up chart of a much longer chart. We took all the different bad things that could have gone on, that have gone on in the world, and we narrowed in on just a few of them. And the difference, why I chose to narrow in on just these few, is that there's some pretty bad things that have gone on in the world, and the stock market has gone up for some of them and down for some of them. So these geopolitical things, as long as it's not an all-out worldwide war, which unfortunately tends to be good for the economy, tends not to affect what happens in our economy. The economy is going to do well or not well, not based on, whether there's riots or a bombing, but based on how the economy looks overall. Now, the recession. Are we going through a recession? And the answer is maybe. And the reason I use maybe is because it doesn't really matter. By the time we know in a recession, it's already happened. The stock markets are forward-looking. So if we take the Great Depression, the financial crisis, and each one of these little bubbles represents the size of the recession, the decline. In fact, if you look at the financial crisis, and I don't know if my arrow is showing here, but it's to the far right, the economy dropped only about 4%. But because it took a lot longer to recover, the stock market took longer to recover. However, the stock market recovered before our economy did. And that's because at some point you realize things aren't going to get any worse. They're probably going to get better. And investors start to buy the stocks before things look like once things look like they're not going to get any worse. Now, take into account the pandemic that we went through. We saw a 10% decline in the economy. However, within just a few months, the stock market not only recovered, but had rallied and gained, if I recall correctly, 20% on the year. And that's because even though things were bad, things appeared to be looking better relatively soon as a vaccine came out, as people learned to deal with and work remotely and deal with how to interact with each other without fully coming in contact. As we learned to live with it, then the economy and the stock market started to recover. So if we are in a recession, it's expected that it's a mild one. And I'm also going to go on record that's going to say in the future, something major will happen that was unexpected, like a pandemic, like a financial crisis, like a major worldwide event, and it will affect our stock market negatively. I don't know when, how, and what, but it always does. Something always happens. And the question is our economy strong enough where people are still going to buy things and continue to do what they're doing? These major events happen all the time, and markets react based on the short-term account happenings, but not the long-term. So it's common for the stock market to decline, but before they even announce a recession, if you see this trend, it shows 2022, but you could see that the stock market began to recover even before we even knew if we were out of a recession or not. And 2023 ended up being a good year. So the last part of this presentation about the stock market, before I get into what you should be doing long term, just talking short term and what's expected for the stock market. If you look at the blue line, that's the top 10 stocks in the S&P 500. So the S&P 500 is the 500 largest US stocks, and most of those are AI oriented. Think of NVIDIA, think of Microsoft, think of a company called Supermicro that makes these servers that house these chips that have to run processing rapidly. Everyone's buying into those particular stocks, and so 10 of them, Google, Microsoft, NVIDIA, Meta's in there, there's a few other ones, they have outperformed everything. And then the bottom 490 stocks are just kind of chugging along there. And you may say, well, oh my goodness, I'm not in those top 10 stocks. Well, first of all, you can be by being diversified using an S&P 500 index. But there's nothing wrong with being out of that blue, because if you look at the green, and if you remember the first slide I showed you of the growth of the stock market over the last year, you can see that you actually had a decent amount of growth from the green. It's just that the blue makes it look so much worse. So yeah, you don't have bragging rights with your friend who bought NVIDIA a couple years ago and doubled and tripled their money. Yet you still have bragging rights that your money is growing at a decent rate and preparing you for retirement, averaging that 9 or 10% over time and recovering from where we were at the bottom. So the point I'm trying to make is, rather than focus on the top 10 or the best performing stocks, focus on just long-term growth. And then the other concern is, what happens when other companies catch up? What happens when Intel or ASML or a number of other chip companies get caught up with NVIDIA? Or what happens when computer makers get caught up with Supermicro, or software companies get caught up with Microsoft? Those stocks have the biggest room to drop. But if you're diversified, if you're in all 500 of them, then you don't have as much to drop, but you still got a decent amount of growth. So the other thing I want to talk about is just being diversified in general, not just in specific stocks, but across the board. So if you look at the top of this chart, you can see 2012, 2013, 2014, different categories of stocks and investments have done better at different times. Now take a look at the bottom, and many times you'll see the same stock that did the best is at the bottom the next year. Look at 2021, REITs, Real Estate Investment Trust did the best in 2021. 2022, they were at the bottom. So every investment has its day. And so you could try to pick the winners. My recommendation is don't pick the winner based on what won last year, because it's probably going to be a different one. Or you can try to be diversified. So you have retirement date funds within your 401k plan, and you have within that, not only does it hold the S&P 500 or a variety of stocks that are US large companies, but it holds some small companies. It holds some bonds depending on how close you are to your retirement date. It adds more bonds, which are lower risk. It reduces risk. It even sprinkles in some international investments so that you don't have all your eggs in one basket. So if you look at that global portfolio of 60-40, 60% stocks, 40% bonds or low risk investments, you see that you're constantly in the middle. You're never the top, but then you're never at the bottom either. And if we go over time, that's where you're getting your 8% return, maybe a little bit more. Some years, some time periods would be a little bit less. And then if you're have many years before retirement and your retirement date fund would probably own even more stocks than that. And yeah, it's going to be risky. It's going to go up and down, but you're diversified. You're not just in those top 10 stocks that have the biggest room to come crashing down. Now, I was supposed to stop and take questions. And so one, I want to encourage people to ask questions. I'm here to answer any questions that you have. And then secondly, let's see, should we pause here? Let's not pause. Let's see what kind of questions have come in, but I forgot to remind everyone to ask questions as we move through this. Well, and that was the last of it. I'll give you a little extra tip on if you have 5 years before retirement, if we go back to the particular slide where we see the bear markets. If you have 5 years before retirement, you can afford to be higher risk. If we look at this big grizzly bear roaring at us, even the worst case scenario, typically within 5 years, you're recovered. The Great Depression was a little longer. That took 10 years. So if you're 10 years off, and I would even argue 5 years off, you can afford to be aggressive if you're okay with that. However, if it's just not your thing, for the first time ever, you can earn good interest rates on low risk or zero risk investments. So within your 401k plan, you have a money market. And I don't know the current rate of that, but that current rate is going to be in somewhere most likely between the 3 and 4%. You can earn 3 or 4%. It's less than inflation, but it's still earning. So there's no reason not to invest if you're afraid of everything that I've said today. If you're still afraid of investing, you can be in the low risk investment and still earn growth, not to mention matching from Graniterock. So if you are approaching retirement, I would recommend that you do a slightly different strategy than 100% into the retirement date fund. And that's because if we do see a period like this, it would be nice to have segmented your stocks from your low risk. That way you can live on your low risk investments while you wait for the stocks to recover. So I'll pause there. Do we have any other questions that have come in? All right.
I have a random question.
Yeah, we have a random question.
Yeah. What is the ballpark dollar amount that a person needs for retirement?
Yeah, so the question is...
And I know it depends, different for everybody, but just generally speaking, how much should we have saved?
Yeah, I get that question a lot, and there's really no answer to that. However, a few years back, it used to be $1 million if you had good Social Security, if you had a little extra income, and you don't live in this area. $1 million could get you a decent income, survivable income to live comfortably. Now that inflation's crept up, I'm seeing that number as I'm projecting for clients, that number's gone further above that, both living expenses and the fact that if you want to live here, you're going to need a lot much larger number. So that's a really good question. And that's where I would encourage you to come see us. The financial review doesn't cost you anything. Graniterock is picking up the tab for that. And in fact, I can jump to that part of what we can do for you. So this is what we do. We just try to find out your needs and goals. We review what investments you have, what you have with the 401k plan here, other investments outside of that, what your Social Security might look like. And then we evaluate your retirement income what your needs are, and then project, do you have enough resources to meet that? And then we'll take a look at, things like taxes. Are you maximizing the tax efficiency of your investments? Maybe you need some help with college planning, or even just a particular goal like buying a home. So, and making sure you have enough life insurance, and make sure your real estate's working the best way possible for you. So these are all things we do a snapshot at. So, one-time meeting, we get you in line and give you some direction to take. So any other questions that have come in? I know people tend to be shy about asking questions, but there is no bad question, and there's probably a number of other people thinking the same question you are, and just they're not brave enough to put it out there.
What would be the minimum you would suggest that a team member at least contribute to in their 401k?
Yeah, so that's a very good question. What is the minimum you should be contributing? So I'll cover that answer because there's no one size fits all. I'm going to cover that in several minimums. The first minimum, if you can do it, is going to be the match, making sure you're fully maximizing the match. And I know it was explained to me what it was, and I've forgotten it since, and I didn't review it before. 50% of your contribution up to a certain amount.
Well, tell the federal tax limit.
Okay. Yeah, so 50%, that gets challenging to fully maximize. So yeah, making sure you're getting some of the match is important. The rule of thumb, so that's another, just going back for a second, if you have a spouse that's also participating in the 401k, a lot of them will give you dollar for dollar match up to 3% or 5%, and just make sure you're doing at least enough for the match there. Now, the next rule of thumb, the minimum amount, is 10%. And a lot of people think that's a high number, and it is. And for some of you, it's just impossible at this time, but that should be your goal. When you run projections, 10% of your assets, of your income, should be going towards retirement at some point in your career, and hopefully the whole point of your career. Now, a lot of times in the early parts, you don't get to 10%, and in the later parts, you can go over 10%. Because maybe kids are out of the house, or that mortgage that was so expensive in the beginning, because it's a fixed rate, has gotten a little less expensive, or maybe someone has gone back to work in the household, or maybe some raises have come. So there's different times, but if you can average that 10%, so if you didn't do 10% early on and you're later on in your career, you should be going above 10%. And then the other one is we can do a projection for you that will tell you exactly what you should be doing, how to get on track for your particular goals. So if you can't do 10, do what you can. Make sure you're getting the maximum match as possible. And then the final one is, and this one's hard to determine, we would have to help you, and that's tax efficiency. You might be just over a particular, and I think there's a camera on me here. So if your income is over a particular tax bracket, I'm going to try to explain taxes with my hands, and it's just too complex to do that, but I'll try. Here's your income, and here's the next tax bracket. Maybe you're contributing enough that brings you down to this, but if you contribute more, remember the contributions you make are pre-taxed. That gets you under this higher tax bracket, and so saves you a lot more taxes above and beyond just saying, okay, I'm going to save some more down to this level. You might just need to go down to that level to maximize efficiency. That may be more than you need to. That may be more than the kind of basic amount that I gave you, but it saves you a lot in taxes. So you're contributing that for tax efficiency.
Okay, I have another question. What are your thoughts on pausing retirement contributions to help pay for college tuition versus taking a loan or something for college tuition?
So that's a very good question. What if you have those dual expenses coming up, college and retirement? Never pause retirement contributions. Even if you have to reduce them, never pause them. And there's a number of reasons for that. Tax efficiency is one. Just moving towards a retirement goal is another one. But the biggest one is you can always borrow for education. You cannot borrow for retirement. If you can come see us or do your own projection, I know T. Rowe Price on their website has a number of calculators as well. You don't have to see us. If you are confident you're on track for a comfortable retirement and you want to pause it and you've done the numbers, you've done the math, then yeah, sure, go ahead. But typically you don't want to stop saving for retirement, not to mention it leaves a free match on the table that Graniterock is giving you. So I never recommend that other than extreme circumstances, even if you have to reduce it. But I would continue with that same amount and borrow. And you know, this is a personal preference. There's nothing wrong with kids having a little responsibility for their education. So not sacrificing your own retirement just for the benefit of them going to college. And that's a personal one, and everyone has their own feelings. And if you feel you can get caught up afterwards, great. But I never recommend, unless I'm confident in the numbers, and I'm not always confident in the numbers, stopping retirement. So that was a great question, maybe even a longer answer than you wanted, but hopefully it gives you some perspective.
That's good.
Any other questions? Well, I'm going to jump here. We do have a more complex, detailed retirement projection that we can run for you that would cost you a little something. Graniterock will supplement the simple projection, and we can do something complex if you have a lot of moving parts. But for most people, the basic projection works just fine, and that doesn't cost you anything. But we do have a more complex one. If you say, well, that looks good, but I have so many other moving parts, then we can do a much more detailed analysis for you. If you'd like to schedule an appointment, you can contact Christina at my office. Notice the new office change. Phone numbers stay the same. And we welcome everyone who wants to set up an appointment. We'll squeeze you in. It's not always me who can do it, but I have a great team of investment advisors that can help you, and I oversee all of it. So after you get advice from them, I'll jump in to see if there was anything else that needs to be added or adjusted that wasn't addressed. So thank you, everyone. Glad to have you back, and I look forward to our next round table meeting together.
Great. Thanks, Jacob. Thanks for being here. We'll see you soon.